I think this has been the biggest gripe that everyone had about these ride-sharing businesses.
20% is a very healthy margin for a marketplace to take. What it says is you have strong network effects. You've got pretty solid lock-in. There's only going to be one or two of these big companies, which is exactly what you've seen.
I think we're going to see Uber flex its muscle over the coming years.
Ride-sharing platforms can now be profitable. I feel like everyone was saying that could never happen, and all of these businesses were doomed, particularly Uber. Earlier this week, Lyft's co-founders had a interview with the Wall Street Journal, and they said that they think Lyft could turn a profit as soon as 2021, which was a year earlier than essentially what Wall Street had expected. And that basically sent Lyft and Uber stock 5 to 10% up as a result of that. And I think this has been the biggest gripe that everyone had about these ride-sharing businesses. Shortly thereafter, then Dara, the CEO of Uber, there was a write-up and seemingly somewhat of a kind of follow-up interview with him, where it was interesting. He was saying, if I rated myself based on accounting of the last quarter, I wouldn't be doing so well. But I live in the real world, he said. And I ran Expedia for 12 years. It was a profitable company. This is what's really interesting to me. Uber's take rate or commission earned, he says, in rides was over 20%. And a great business can be built with a 20% take rate. What do you make of this, Nick? 20% take rate. It's probably actually much higher than what they were taking at an Expedia from the hotel industry. And we've seen other industries like the food industry, Grubhub taking much less than 20%, but still being a public company with a profitable business underneath it. Do you think 20% is the floor to have a successful marketplace business? Or is he just saying we actually have a very strong business because it's at least 20%?
I would say it's the latter. Alibaba for years didn't take a take rate, still built a great marketplace business. Obviously. And I think 20% is a very healthy margin for a marketplace to take. What it says is you have strong network effects. You've got pretty solid lock-in. There's only going to be one or two of these big companies, which is exactly what you've seen. If you can take 20%, typically when you see lower take rates, it means one of two things. One, you have weak network effects and can't actually capture that market. And there might be some issues going on there. And then two would be you have issues with platform leakage. And you're concerned that if you do take a big take rate, people will take the transactions offline, which was the case with Alibaba and its marketplaces originally. So I think if I'm Uber and I have a 20% take rate, I think the challenge for them is their marketplace isn't just digital services. There's physical services, people actually delivering rides. So there's costs associated with building and maintaining that network and fixed costs like insurance. So the unit economics are different than even a product marketplace being a services marketplace. But I think 20% for a services marketplace is quite healthy, and I expect that over time that margins are going to improve. I think where they lose a lot of money right now is really in those emerging markets where costs are high. They're spending gobs of money on user acquisition. They've got issues with fraud and have had that historically in emerging markets. So a lot of that money isn't necessarily actually helping. And costs of rides are lower, so they're just not going to make as much profit there in the short term.
Yeah. I mean, they do talk about India in this article as well for Uber, and it being a huge growth driver for them. And I think that just goes back to the platform conglomerate status of Uber versus Lyft, and why long term I'm just more bullish on Uber than Lyft. Doesn't mean Lyft won't be profitable or won't have a successful business, but I think we're going to see Uber flex its muscle over the coming years. And we've already seen it do that and highlighted on the show with things like Uber Pets, which I think is going to be awesome. And these kinds of things. I think it's a good point, though. Service marketplaces might needing a higher take rate than product marketplaces, especially when the service marketplace has a strong kind of physical delivery component where things could go wrong. And the marketplace needs to make people whole or have kind of slippage in there or lossage factored into just the operations of the business. Where if it's a product marketplace, it's a seemingly a little bit more straightforward from a fulfillment standpoint. Also, if you look at like these home service marketplaces like Handy and IAC did the roll up with Handy and Angie's List, it's a very tough business. And you're really needing to, what is the service you're really selling? Basically time. And when things get messed up, you can't just refund someone's time. It's a very different kind of economic model, even more so than a product marketplace. Or at least I can get you the product. Maybe there's an inconvenience because it didn't get to you on time, or maybe the product is damaged. I can still make you whole.
I think the benefit that a Uber has over something like a Handy, though, is they're one-off transactions, super commoditized. So like if I'm shopping for a home cleaner, I might use Handy, but if I find someone I really like, why not just contract with that one person? So there's
much less commoditized of a service,
and there's a much more of a human relationship component to that. Whereas just getting from A to B, unless you're an executive at a big company and have a private driver and security risks and that kind of thing, you don't really care. You're just getting in an Uber going from A to B.
Hi, this is Alex from Winner Take All. Thanks for joining us. Hope you enjoyed the content. Feel free to leave a comment, ask us questions, and definitely make sure to join us on our next live stream.